Your money is sitting in your bank account right now. You can see it. The balance is there. Every dollar you saved, every dollar from your Social Security deposit, every dollar you put away over a lifetime of work, it is all showing on the screen. And your bank can lock every single cent of it without calling you first. Not because you did anything wrong. Not because you are under investigation. Not because there is any fraud happening on your account. Simply because an automated system decided your transaction looked unusual, and under rules that quietly went into effect in 2026, your bank now has the legal authority to freeze your funds, hold your money, and investigate your own spending before you are allowed to access what is yours. This is not a hypothetical. This is not a worst-case scenario being used to frighten you. This is happening right now to seniors across this country. People standing at pharmacy counters with debit cards that are suddenly declined. Not because the money is gone, but because the account is locked. People trying to pay a contractor, help a grandchild with college tuition, or transfer money between their own accounts, only to find their funds placed on a hold that can last anywhere from 5 business days to 2 full weeks. And the number that should stop you cold, according to the FBI and the Federal Trade Commission, elder financial exploitation now costs American seniors more than $3 billion every single year. That figure has driven an aggressive response from regulators, from state legislatures, and from the banks themselves. The tools they built to stop fraud are real, they are powerful, and for millions of innocent seniors living on fixed incomes, they have become a trap. If you have a bank account and you are over the age of 60, what you are about to hear is not something your bank is going to put in a letter. They are not required to explain it to you in advance. You will only find out it applies to you when it is already too late to prepare. What changed in 2026 is something most Americans have never heard of. It is called the speed bump rule, aligned with FINRA Rule 2166 proposals, and it was introduced by federal regulators in January 2026. Under this rule, financial institutions are now authorized to place a temporary hold of up to 5 business days on any transaction they believe may be fraudulent. The hold can be applied to any customer. But in practice, it is being triggered almost exclusively on senior accounts, because the behavioral profiles that flag suspicious activity are built around patterns that older Americans display more frequently than any other group. Large one-time transactions, transfers to family members, withdrawals outside of normal routine, payments to new vendors or contractors, even logging into your banking app while on a phone call, which AI systems have flagged as a marker of tech support scams, can trigger an automatic hold on your account. And here is where the situation becomes genuinely serious for retirees specifically. Unlike a standard fraud alert that used to be resolved with a phone call, these new holds often require a formal internal review before your funds are released. You cannot simply call your branch and explain the transaction. The hold stays in place while the bank's compliance team reviews the case, and depending on the institution and the state where you live, that review can take far longer than the initial 5 business days. If the bank system determines there is a reasonable belief of fraud, they can extend the hold significantly. In states like Florida and Minnesota, legislation strengthened in 2026 now allows banks to delay disbursements from senior accounts for 15 to 45 days if financial exploitation is suspected. For a senior living on a fixed monthly income, a 15-day freeze on their checking account is not an inconvenience. It is a crisis. Utility bills go unpaid. Prescription pickups get declined. Mortgage or rent payments bounce. The part of this that most people find genuinely alarming is not the holds themselves. It is who authorized them and what legal protection banks now have for using them. For decades, banks were cautious about freezing customer accounts because they feared being sued for what is legally called wrongful dishonor, the wrongful refusal to process a legitimate transaction. That liability acted as a natural check on how aggressively banks could intervene in customer accounts. That check is now largely gone. As of 2026, over half of all U.S. states have passed what are called safe harbor laws. These laws grant financial institutions, and individual bank employees, legal immunity when they freeze a senior account in good faith based on a suspicion of elder exploitation. The bank does not need proof. They do not need your permission. They do not need a court order. They need only a reasonable belief, as defined by their own internal systems and the judgment of their own employees, that something unusual may be happening. What this means in practice is that the barrier to freezing your account has been dramatically lowered, while your ability to challenge that freeze quickly has not meaningfully improved. Under these safe harbor protections, a bank teller who notices that a senior customer appears nervous, or is accompanied by someone unfamiliar, or is making a withdrawal that seems inconsistent with their normal pattern, can now trigger a hold and report the incident to Adult Protective Services. No verification required. No conversation with the account holder required. The hold goes on first. The questions come later. And in most states, once a report is filed with Adult Protective Services, the investigation process moves on its own timeline, not yours. This has created what banking researchers are calling a false positive problem. The same systems designed to stop actual elder fraud, AI monitoring tools, behavioral profiling algorithms, automated transaction screening, are regularly flagging innocent transactions made by seniors who have done nothing wrong. A grandmother sending her grandchild a birthday gift. A retired veteran transferring money between his own savings and checking accounts. A widow paying a new home repair contractor after her husband passed away. All of these have triggered automated freezes under the new rules. There is a second layer to this that most seniors have never been warned about. Many older Americans maintain what financial planners call a dormant savings account, a backup account they rarely touch, kept for emergencies or for passing along to family. In 2026, automated banking systems are aggressively flagging these accounts for review. Critically, automatic deposits, like interest payments, no longer count as activity under the new dormancy detection rules. That means an account receiving regular interest deposits can still be classified as dormant by the system, triggering a review and potential restrictions on access. For seniors who have kept a quiet emergency fund in a secondary account for years, assuming it was safely sitting there when they needed it, this is the kind of discovery that tends to come at the worst possible moment. There is also a provision in the new rules that almost nobody in the banking industry has explained to their senior customers, and it is arguably the most important thing you can do right now to protect yourself. It is called a Trusted Contact Designation. Under FINRA Rule 4512 and similar federal banking guidelines, every account holder has the right to formally designate a trusted contact person on their financial accounts. This is someone the bank can reach out to, not to access your account, not to make decisions on your behalf, but simply to verify that you are safe and that a transaction you initiated is legitimate. Having a trusted contact on file creates what banking professionals refer to as a release valve. When the automated system flags a transaction on your account, the bank can call your trusted contact to quickly confirm the transaction is legitimate, and in many cases, this resolves the hold before it has any impact on your access to funds. Without a trusted contact on file, the bank has no one to call. The hold stays. The internal review proceeds on its own schedule, and you wait. The process to add a trusted contact takes less than 10 minutes. You can do it by calling your bank directly, visiting a branch, or in many cases through your online banking portal. Ask the representative specifically to add a trusted contact under FINRA Rule 4512 or your bank's equivalent program. Provide the name, phone number, and relationship of the person you designate. This does not give them access to your money. It does not make them a power of attorney. It simply gives the bank a way to verify your identity and your intentions quickly, and that single step can be the difference between a transaction that goes through normally and one that sits frozen for 2 weeks while an internal investigation runs its course. There are also specific transaction behaviors that significantly reduce the likelihood of triggering an automated hold, and seniors who know them are navigating the new banking environment far more smoothly than those who do not. If you have a large transaction coming up, a home repair payment, a transfer to help a family member, a significant purchase, call your bank 48 hours in advance and tell them about it. This is called pre-clearing a transaction. You are not asking for permission. You are simply creating a record in your account file that the upcoming transaction is expected and authorized. When the system flags it, the pre-clearance note is there and the hold is less likely to be applied. For regular transfers to family members, the same principle applies. If you routinely send money to an adult child or grandchild, ask your bank to note that this is a recurring authorized transfer. Recurring transactions that match a consistent pattern are far less likely to be flagged than one-time transfers of similar amounts. Avoid initiating large transactions through your banking app while you are on a phone call with anyone. AI monitoring systems in 2026 are specifically trained to identify the combination of an active phone call and a financial transaction as a high-risk indicator, because this is a common pattern in tech support and grandparent scams. If you need to make a significant transfer, End the call first. Make the transfer. Then continue the conversation. The harder truth behind all of this is something that needs to be said plainly. The rules that are creating these problems were written to protect seniors from real exploitation. Elder financial abuse is a genuine and growing crisis. The $3 billion annual figure is not an exaggeration. Scammers specifically target older Americans because they are more likely to have accumulated savings, less likely to immediately recognize certain manipulation tactics, and in many cases, less likely to report what happened out of embarrassment. The banks are not wrong to want to intervene. The legislators who passed safe harbor laws were not acting with bad intent. But the result of well-intentioned protection applied through automated systems that cannot distinguish between a grandmother sending birthday money and a romance scam victim wiring their life savings overseas is a banking environment where innocent seniors are being denied access to their own money with increasing regularity. And the seniors who are navigating this environment without disruption are not the ones who got lucky. They are the ones who knew the rules had changed, added a trusted contact to their accounts, pre-cleared their large transactions, and stopped assuming that because the money was in their account, it was automatically available to spend. The banking system in 2026 is not the same system it was 5 years ago. The rules have changed. The technology has changed. The legal protections for banks have changed. The only thing that has not changed yet is whether you know about it. Now you do. This video is for educational and informational purposes only and does not constitute financial, tax, legal, or banking advice of any kind. Banking rules, state safe harbor laws, and federal regulations vary by institution and jurisdiction and are subject to change. Always contact your financial institution directly for information specific to your accounts. Federal Decoded is not affiliated with any bank, government agency, or financial institution.